Almost midway through the second quarter after a strong Q1. We want to check on expectations for growth in the second quarter and how a renewed trade battle could change things. Steve Liesman is here with the latest. Steve.
Yeah, Melissa, our first look at Rapid Update is in for the second quarter. And the caution here is there is not a whole lot of data here. But we have a number nonetheless because we have a trade deficit number and we have the car number. So 3% now is the tracking for Q1. That's come down by 0.2 from the original print. Of course, the CNBC Rapid Update is the median, the only median on the street of 10 to 12 tracking forecasts that are out there. And there's the first number for the second quarter, 2%. You put them together, you're running about 2.5. That seems and feels about right to me. I believe it's the number that our guest host, Mohamed El-Erian, talked about before. Let's look at some of the estimates out there. Stephen Stanley, Amherst Pierpont, he's on the high side of 3%. Moody's, which puts together the list for us, 2%. Goldman Sachs at 1.9%. And the Atlanta Fed, which I don't like their early number at all. I think it's biased to the whatever the ISM is, and that was weak. So they come in weak. They're at 1.7 along with Deutsche Bank. Let's look at the estimated impacts of trade here. The tax cuts, according to our CNBC Fed survey, are going to add 0.4 to potential growth. Okay. Now this year and next, tariffs will take off 0.2 of that, and the global slowdown, which I think is related to the tariffs, 0.3. And what we have here is an argument between folks who disagree with the means, and I think everybody agrees with the ends. Let's talk about the upside of these talks being successful. Less intellectual property theft, greater market access for U.S. companies to China, and ultimately more efficient markets. If the Chinese government is subsidizing companies, that's negative for global growth in general. Trouble is the means, the downside of the tariffs. Lower growth near term, higher prices, and less efficient markets as people have to say, you know what, it's 25% more expensive potentially in China to get this thing. I'm going to find a way around that. That means they go to Thailand or they mean to go someplace else. Question is, do they ever bring it back here? And for that, I think you're going to need long-term sustained tariffs. And that's really one of the things the market worries about.
So, Steve, this is a classic journey versus destination.
Exactly.
You like the destination, you don't like the journey.
Right.
Right? The question then is, how long is the journey?
I mean, I think we thought that the journey was coming to an end. We were getting our coats on. We were getting stuff in our briefcases. We were zipping up the briefcases. And then Sunday, we got an idea that we had another couple legs to the journey. The problem I have is not that. The problem I have is if the administration really wants to reduce the Chinese-U.S. trade deficit, if they really want to help U.S. companies start and take back some of that business, it strikes me you're going to have sustained tariffs. And that is the real fear, that it's not just, tariffs are not just the journey, the tariffs are ultimately an end if they want to have protection. According to something sent around yesterday by Torsten Slok from Deutsche Bank, the U.S. now is one of the highest tariff countries in the world, higher than other. Now, if it's just a journey, I think everybody's cool with that. But if it's an end, then we got problems, I think.
What if the current tariff regime is the sustained tariff regime? Does it then have any impact on the economy? Or
yes.
have we seen, it
if
does.
It's the sustained tariff regime.
It has more of an impact than what we've already seen in the past 6 months.
Look, and I think Joe said this earlier, the impact is de minimis, right? It's about maybe half of the potential impact of tax cuts this year, but the tax cuts should keep on giving. The way the economists had done this, for what it's worth, ladies and gentlemen, you can take this for what it's worth, is they dialed in a 0.2 decline this year and no decline next year. So you go from 10% to 25% of the tariffs. It means you deepen and longer, and you make deeper and longer the potential negative impact.
When did we invent the wonderful income tax? Was that 1908 or something? When was that, Steve? Do you remember? But prior to that, it was all tariffs. That's how we funded.
That's how we funded the government. Right.
Is it possible, Andrew? You ready to sign on for that? No more income tax, just all tariffs, dude? Huh? Think about it. Might be hard. That might be difficult, right?
Got to think about it
at this point.
Impossible.
But there was impossible. But we were a tariff country for probably
That's
longer.
True.
From when we were founded, longer a tariff country.
We also
maybe
didn't run the world back then.
What's that?
We didn't run the world back then.
We didn't have penicillin back then, so there were things that weren't
penicillin.
There were things that weren't so great.
We didn't understand the importance of say, communicable diseases. We didn't have medical education back then.
There were some other issues.
Can I just
probably won't go back there, but tariffs are not. It's not a new concept.
No. But
we shouldn't be annualizing these effects, though, because I don't think anyone thinks it's going to. we still think
We didn't, but
I
now
know,
we do.
but I still think we still think it's basically a bargaining.
We had 77% of our Fed survey respondents believing there was going to be a deal this year between U.S. and China. That was in the prior survey. I don't know what the answer would be now. This year.
Well, we were hoping this week.
Right. There we go. Can I just ask very quickly, Mohamed, here? I have. Oh God, I can't believe this number. Here's the number. I'm not doing anything with it. 91% chance of a cut January 2020. I think a more believable number that the market's really pricing is a 54% cut by December.
Yeah, so
is the market on sides or off sides here, Mohamed?
I think both are high. Both are, in fact, very high. I think that the baseline is no change, and the balance of risk is towards a hike, not a cut. That's why I think those numbers are way too high.
You know, this is historic. You are right in line with our survey respondents, 63% of whom said that the Fed would be hiking in 2020 versus the market, which has a majority plus of a cut. And for the 10 or 12 years I've been doing this survey, I don't know how long it's been, the market and our respondents are almost always together. I don't understand the split here, but the market certainly is betting. People betting with their money.
So can I provoke you?
Please.
Don't you think the market feels it can bully the Fed?
Maybe. I mean, maybe it feels that way. I just don't
Look
think
at the
people...
tantrum. You know, it's...
But the consensus, I don't trust economists' consensus. And I mean, if you're really going to go against the grain, the more surprising, I think rates are going up. I mean, who doesn't? You just got to tell people what the employment. Tell people what the unemployment rate is. It sounds like we're going higher.
Let me push back a
new
little
highs
bit.
in the stock market. So the obvious thing is that rates go higher. Maybe it doesn't turn out. Maybe the consensus is wrong again.
I'll push back a little bit.
The market's right.
These guys, I like to say, don't tell a blind man where the furniture is in his house.
They're looking
if he
beyond.
knows one thing, he knows that. And this group I've been following, they get the Fed almost always right. They are not separated.
Did they get the Fed right last year?
Yeah, they did.
Very tricky
they
year.
did. They had that fourth hike in there. They stuck with it despite the change in.
Did they have the pause?
The pivot.
The pause,
or the pivot.
I'd have to go back and look. I'd have to go back. But that, I think, that came on everybody very suddenly. I don't even know if we were able to pull for it.
What if inflation stays so low and growth stays where it is?
I think that's an issue, Joe. And I will tell you another thing I'm working on now that I have the data for it. I haven't had a chance to get it presented, is people don't believe in the Powell transient explanation. And one piece of data that I have, you remember he mentioned financial services declines?
Yes,
I do.
And I question that because it seems like a structural change in the industry where fees are pressured permanently.
That could be, or the idea that something is pressured permanently at all times in the economy, in a downdraft, which I think what Joe's talking about, the idea that you have this inflation. And statistically, if you look at a trim mean, which the chairman cited, the Dallas trim mean, you will always miss that one thing that's going down because you're always chopping it out of your calculation. But here's the story with the financial services. It was down 3.7% on the month. So you're right to think, except when you were near 2% inflation last year, that number was up and helping it be near 2% last year. So you can't selectively remove it. And some of the things that are transient, a lot of economists are questioning whether or not it really is transient, which means Joe could be right. If you're down 1.5, 1.4, you've got an inflation problem. I think there are some members of the Fed that are thinking about how do we address this?
But, Steve, we talk about Amazon, we talk about Google, we talk about Uber. Amazon disintermediates, lowers prices. Google makes price searching very easy.
Yep.
Okay.
Yep.
And then Uber brings on assets that are underemployed.
Can I tell you the coolest thing that I've come across recently?
Hold on. I worry that we're so obsessed that 2% is the right number that we forget that by trying and to target 2%, we may break something somewhere else.
That's possible. The coolest thing I saw recently, I don't know if you guys remember the story I did about the government's use of big data. So a big department store decided they didn't want the government price takers in their store. They said, you know what? We're going to send you a file at the end of the month with real prices, okay? What happened to the apparel prices in the last CPI report? They fell 1.9%. That suggests, it's not evidence, but it suggests we ought to be looking at the idea of what the government guys, when they go in to write down the prices, that real prices paid by people might be lower, which suggests the Google, the Amazon, the Uber, the everything, you might have a bigger downdraft of technology-driven inflation.
1.55% is actually lower.
Right, exactly. That it really, but no, economists have, by the way, to their credit, suggested that the inflation numbers are overstated. And now I'm going to get a whole bunch of Twitter mail, or whatever you call it, tweets, saying, Liesman, how can you say prices are going down when all my prices are going up? And
see that too, and people talk about healthcare premium, things like that.
Education.
But then think if we get think if finally we do get some cost containment
on healthcare.
Right.
Well, it depends how we get there.
But by definition, folks, almost none of you out there is experiencing the actual CPI. It is an average of a price basket, and you are not doing it. But that's the best we got.
The more you know.
Which ain't that good.
Liesman, thank you.
The more you know.